Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Tuesday, February 17th. In his Big Picture column this week, Briefing.com CEO Dick Green takes a look at the impact massive federal spending programs had on the stock market in the 1930s, with an eye on the prospects for the Obama administration's $787 billion plan. Dick points out that the unemployment rate in 1932 was 24%. 6 years later, despite a massive increase in federal spending, it was only 19%. The economy took 7 years to recover lost ground of the early 1930s, and the stock market 2 decades. There is no guarantee that the recent stimulus package will alleviate economic woes or support the stock market. The current economic situation is not nearly as desperate as during the Great Depression. Real GDP was nearly flat in 2008. The level of real GDP in the fourth quarter of 2008 was down just 0.2% from the fourth quarter of 2007, while total 2008 real GDP was up 2.2% from 2007. This is in stark contrast to the 8.6% drop in real GDP that occurred in 1930 at the start of the Depression. After that, it got even worse. In 1931, real GDP fell 6.4%, followed by further declines of 13% in 1932 and 1.3% in 1933. In total, real GDP fell over 25% in the 4 years from 1930 to 1933. The economic downturn that started in late 1929 was far, far worse than the current economic downturn. The stock market crash, too, was also far worse. The Dow hit a cyclical peak of 381 on September 3, 1929. It then started lower, and after a crash of 31 points on October 29th, it fell to 230. That was a drop of 40%, not entirely dissimilar to the current downturn. In the following years, the stock market fell further as the economic downturn worsened. The Dow fell to 41.22 by July 3, 1932, for a total decline of 89% from the peak in 1929. The drop from the peak in the Dow in the current cycle is just 45%. The data show that from 1930, as the stock market crash deepened and as the Depression set in, federal spending rose from 3.5% of GDP to 10.7% in 1934. The impact of increased federal spending reversed the decline in real GDP. This is not surprising because the drop had been so severe, over 25%. Despite the upturn, however, real GDP did not get back to the 1929 level until 1936. Thus, it took 7 years for the economy to recover. The fiscal stimulus of that time stopped the hemorrhaging. It did not, however, stimulate the economy such that the private sector regained momentum and started to grow again. The impact on the stock market was even less impressive. The Dow did not regain its prior peak of 381 in 1929 until 1954, a full 25 years later. Furthermore, the long recovery period was not due to the spike of 1929. The Dow in 1945 was about where it was in 1925 and not much higher than it was in 1920. The most startling delay in any perceived impact from the fiscal stimulus of the early 1930s, however, comes from the employment data. It was World War II, not federal spending, that truly produced the decline in the unemployment rate back to pre-Depression levels. As the data show, the sharp increase in federal spending from 3.4% of GDP in 1930 to 10.7% in 1934 had little impact on the unemployment rate. The work programs did not work nearly as well as suggested by the myth of the New Deal. Work programs employed people in the government sector, but employment in the private sector remained stagnant despite the fiscal stimulus. So what does it all mean? The $787 billion stimulus package of 2009 is comparable to the ramp-up of federal spending from 1930 to 1935. During that period in the early 1930s, the economy bounced significantly after 1933, but took 7 years to recover all the lost ground. The stimulus in the 1930s did little for the stock market, which continued to decline for years after the 1929 crash and took decades to recover all the lost ground. The stimulus in the 1930s had even less of an impact on the unemployment rate, which remained high throughout the New Deal period of high government spending. Economic conditions are not nearly as bad now as in the 1930s. The current stimulus package is not facing all the hurdles that existed in the 1930s, and thus might arguably have more impact. The experience of the 1930s, however, shows that there is no reason to assume that just because government spending increases, that the private sector will respond significantly enough for the economy to generate upward momentum. It is by no means certain that the economy will recover in late 2009 or 2010. It may take much more than an increase in federal spending and tax cuts to get the economy back on track. To read Dick's article in its entirety, put your cursor on the RView tab at the top of the page and select the big picture, which is the fourth page listed on the drop-down menu. I'm Pat O'Hare for Dick Green and Briefing.com. Thanks for listening.